Ladies and gentlemen, good day and welcome to the Raymond Ltd Q1 FY2024 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Priyanka Trivedi from Antique Stock Broking Limited. Thank you, and over to you, ma'am. Ms. Trivedi, the line for you has been unmuted. You may proceed. Ms. Priyanka Trivedi, the line for you has been unmuted. You may go ahead. Ladies and gentlemen, please give us a moment. Ladies and gentlemen, we thank you for your patience. Ms. Trivedi, you can go ahead.
Thank you. So on behalf of Antique Stock Broking, I would like to welcome all the participants in the Q1 FY24 conference call of Raymond Ltd. I have with me Mr. J. Mukund, who is the Head of Investor Relations of Raymond Ltd. Without taking further time, I would like to hand over the call to Mr. Mukund. Over to you, Mukund.
Thank you, Priyanka. Good evening, everyone, and thank you for joining for our Q1 FY24 earnings call of Raymond. I hope you would have received a copy of our results presentation. I would like to urge you to go through this along with the disclaimer slides. Today we have with us from the senior management of Raymond, Mr. S.L. Pokharna, who is Director of Raymond Limited, Mr. Amit Agarwal, Group CFO, Mr. Sunil Kataria, CEO of Lifestyle Business, Mr. Harmohan Sahni, CEO of Real Estate, and Mr. Jatin Khanna, Head Corporate Development. Now I would like to hand over the call to our Group CFO Amit, who will give you the summary of company's quarterly performance before we open up for Q&A. Over to you, Amit.
Thank you, Mukund. Good evening, everyone. Thank you for joining us today for the earnings call to discuss the results for the first quarter of fiscal 24. Let me start with a brief overview of the market for the quarter. As you may be aware, that quarter one is a seasonally weak quarter with low consumer demand given the absence of occasion and festive-led spending. Also, this subdued sentiment across markets impacted brands across categories related to discretionary spending. Additionally, factors such as weather conditions have had a significant impact on consumer demand. While there was a marginal uptick in consumer sentiments owing to the summer weddings in the month of May and June, however, the weather conditions such as heat wave across India, followed by incessant rain, mainly in northern India, led to lower walk-ins in malls and high street retail outlets. In the branded apparel segment, the early onset of the end-of-season sale in the month of June and higher discounting by large e-commerce online players have had an impact on the store sales as well. Now let us have a look at the consolidated financial results for the first quarter fiscal 24. Despite being in quarter impacted by subdued consumer demand, we were able to sustain a good performance and delivered highest ever first quarter revenue of 1,826 crores with a growth of 4% over 1,754 crores in the first quarter of fiscal 2023. It is heartening to see this as 7th consecutive quarter of consistent performance. The revenue growth was driven across B2C businesses of our branded textile and branded apparel and well supported by B2B business of high-value cotton shirting in the domestic markets as well as in the garmenting business in the export markets. At the EBITDA front, we recorded the highest ever first quarter EBITDA of 252 crores with a healthy EBITDA margin of 13.8% as compared to an EBITDA of 235 crores in the first quarter of fiscal 2023. Also during the quarter, the Nomination and Remuneration Committee of the company on 13th May 2023 has granted 1,380,588 stock options, almost 2% of the total outstanding shares, to the eligible employees of the company and its subsidiaries under Raymond Employee Stock Option Plan 2023. Accordingly, the company has recorded a cost of 3.9 crores during the quarter of 30th June 2023. Excluding the ESOP cost of 3.9 crore, the EBITDA could have been higher at 256 crore with a higher EBITDA margin of 14%. Most of the businesses contributed in delivering the highest EBITDA in the quarter, with branded textile, garmenting and engineering leading the front. However, real estate EBITDA was lower due to launch cost of the new project 10X Era. During the quarter, the company recorded exceptional item expense of 9 crore related to voluntary retirement scheme in one of the suitings plants located in Chhindwara, Madhya Pradesh. In the quarter, we announced and completed the slump sale of our FMCG business in our associate company, Raymond Consumer Care Limited, to Godrej Consumer Products Limited for a total consideration of 2,825 crore with net of tax realization of 2,200 crores. We have received the consideration and accordingly the transaction stands concluded. As Raymond Limited holds 47.66% shareholding in RCCL, 983 crores related to share of Raymond Limited of profit on sale of FMCG business in Raymond Consumer Care Limited has been accounted for. Including this, we reported a net profit of total 1,065 crore in the quarter. Now let me discuss about the segmental performance for the first quarter of fiscal 2024. The branded textile segment reported a healthy growth of 6%, driving sales to 688 crore in the first quarter of fiscal 24 as compared to 648 crore in the first quarter of last fiscal year. The growth was driven by strong volume growth in the B2C shirting business, a reflection of consumer offtake of our new casual wear categories, an increased range of cotton and poly blends, which were well received by our trade partners and customers. In the suitings business, the sales growth was driven through a combination of volume growth and increase in average selling prices due to mix improvement. The innovative product offering and gifting solutions for the summer weddings was well accepted by the consumers. Amidst the backdrop of summer wedding season, we witnessed traction of large purchases by our customers, leading to 8% growth in average transaction value as compared to previous year in the Raymond shop network, that is TRS network. The segment delivered an EBITDA margin of 17%, marginally lower as compared to 17.6% in the first quarter last year. Now let me talk about the branded apparel segment, which showed a healthy sales growth by 16% to 305 crores as compared to 262 crores during first quarter of the previous year. The top line growth was witnessed across all brands, with Color Plus, Raymond Ready to Wear, Parks leading the front and well supported by Park Avenue and Ethnics by Raymond. In a subdued consumer demand environment, we witnessed sales growth in our strong retail network of over 1,400 stores of the Raymond shop, TRS and EBOs. With the increase in doors in MBOs and large format stores, the sales growth was further amplified. The segment also witnessed an improved EBITDA margin of 6.4% in the first quarter of fiscal 24 as compared to 5.6% in the previous year. The improvement is mainly led due to operational leverage and efficiencies. Now coming to our retail network, we continue to further strengthen our retail footprint by opening 37 new stores during the quarter, which led primarily by Ethnics by Raymond, EBOs, along with new EBOs for Raymond Ready to Wear, Park Avenue and Color Plus stores. The expansion across metros, Tier 1 and Tier 2, Tier 4 towns on a pan-India basis. In line with stated strategy of ethnic store expansion, we opened 15 stores during the quarter, leading to a total of 75 stores of Ethnics by Raymond as on 30th of June 2023. The remaining stores were opened mainly for Raymond Ready-to-Wear, Park Avenue, Color Plus, and the Raymond Shop. Also during the quarter, we have closed some 39 stores, which is mainly a combination of relocation of stores and closure of some Parks brand EBOs, as we are focusing on expanding the brand outreach through multi-brand outlets, MBOs, LFS, and online channel in line with our stated strategy. Overall, as on 30th of June 2023, our retail network stood at 1,407 stores spread across 600 towns and cities. Now let me talk about the garment segment, which reported a growth of 7% to 265 crores compared to 247 crores in the previous year due to continued higher demand from our existing and newly acquired global customers. EBITDA margin for the quarter was 9.2% as compared to 6.1% in the previous year, mainly due to operating leverage and operational efficiency. Also, the capacity expansion in our plants is well underway as per plan, which will cater to the increasing demand in the coming months. Let me talk about now the high-value cotton shirting segment, where the top line grew by 13% to 192 crores compared to 170 crores in the previous year, led by demand for our cotton and linen fabric offerings by our B2B customers in the domestic market. EBITDA margin for the quarter was marginally higher at 10% as compared to 9.7% in the previous year, mainly due to operational efficiencies. Also, during the quarter, Raymond Ltd Limited, which is a subsidiary company, as part of buyback process, purchased the entire shareholding of Cotonificio Honegger SPA, Italy, the erstwhile joint venture partner of Raymond Ltd in RLCL, for a consideration of 19.11 crore. Consequently, with effect of from 9th June 2023, RLCL is a 100% wholly owned subsidiary of Raymond Ltd. Coming to the performance of the engineering business, which is consolidated under JK Files and Engineering Limited on an aggregate basis, the sales were maintained at 209 crores in the first quarter FY22, similar to first quarter FY23. In the domestic market, the demand momentum was well maintained, especially in the passenger vehicles, commercial vehicles, and industrial sectors, driving growth in ring gears, flex plates, and bearing categories. In the export markets, we witnessed growth driven by ring gear and other categories in a globally inflationary environment. EBITDA margin for the quarter was higher at 14% as compared to 12.8% in the previous year, mainly due to operational efficiencies, and the impact of euro depreciation has also reduced. However, the devaluation of currencies in certain regions continued to impact the overall business. Now, coming to the real estate segment performance, we maintained a strong booking momentum during the quarter. During the quarter, we received a total of 215 bookings in our 3 projects for a total value of 330 crores. Our 2 brand offerings of 10X and Premium offering under Address by GS brand has been well accepted into the market. In the 10X brand offering, which includes 10X Habitat and 10X Era, we received 174 bookings with a booking value of 237 crores as compared to 157 units with a booking value of 175 crores in the first quarter fiscal 2023. The launch of 10X Era project in February 23 contributed to the booking momentum, as 80% of the units are already sold in the 10X Habitat. In the Address by GS Premium brand offering, we received 41 bookings with a booking value of 93 crores in the first quarter fiscal 24 as compared to 102 bookings with booking value of 270 crores in the first quarter fiscal 23. With 87% of the inventory already sold in this premium brand, July 2023, we launched the Address by GS Season 2 with similar configuration, for which we have received an overwhelming response, and we made a booking of 50 units on the launch day itself. The construction momentum in all the three projects is being maintained well. In the 10X Habitat project, first 3 towers have been delivered, which is 2 years ahead of the RERA timeline in December 2022, and the tower 4 to 8 terrace slab have been completed, and 27th and 28th slab have been completed for tower 9 and 10 as well, respectively. In the Address by GS project, 7th and the 3rd slabs have been completed respectively in Tower A and Tower B. In the 10X era project, excavation has been completed for Tower B and foundation work is in progress for Tower C. The business delivered a sales performance of 234 crores, which is 18% lower as compared to 286 crores in the first quarter of fiscal 2023. The revenue recognized during the quarter is not comparable with the previous quarter, as we follow the percentage of completion method for revenue recognition, which is based on incremental percentage of completion of different towers in different projects. The EBITDA margin stood at 23% for the quarter, slightly lower as compared to 27.5% in the same quarter last year. Now let me talk about the working capital and cash flows. On the working capital front, in general, while the first quarter of the year is seasonally weak, however, from the month of June onwards, in order to cater the upcoming festivities and wedding seasons in second half, the working capital starts getting built up, especially the inventory, as the lead time in the fabric business from raw material procurement to finished fabric being available at the retail store is about 3 to 4 months. The net working capital stood at 1,583 crores as on 30th of June 2023, higher by 318 crores as compared to 1,265 crores as on 31st March 2023, and higher by 260 crores as compared to 1,323 crores as on 30th of June 2022. The increase is mainly on account of increase in inventory catering to the upcoming festive season, and also due to construction costs and approval costs related to the new projects. While the inventory has increased given the seasonality, however, there has been a continued focus on efficient working capital management. We have seen strong cash collections in place, which has been able to help the reduction in receivables on an absolute terms. Now regarding cash flows, due to increase in net working capital for the quarter, our operating cash flows have been utilized to the tune of 149 crores. During the quarter, we also incurred an capex of 58 crores, mainly in the ongoing capacity expansion in the garmenting and the engineering business, and maintenance capex across our various plants in various businesses. With increase in the net working capital and post-capex and interest costs related outflows, our free cash flow for the quarter was a net utilization of 260 crores. Now let me discuss about the debt position of Raymond Group after considering the utilization of the net of tax realization proceeds from FMCG business slum sale in Raymond Consumer Care Limited. The FMCG business sale proceeds were 2,825 crores with an estimated after-tax realization of 2,200 crores. Post this transaction, the Raymond Group has become net debt-free 2 years ahead of stated guidelines, with over 1,500 crore of surplus cash available for future growth. Now let me explain the utilization of the FMCG sale proceeds. In order to facilitate external debt reduction at consolidated level, Raymond Ltd issued non-convertible debentures to the tune of 1,700 crores to RCCL. From the total 2,200 crores net available, 1,029 has been utilized for prepayment of external borrowings, and balance amount in Raymond Ltd and RCCL has been invested into liquid investments. Our external gross debt, excluding accrued interest, stood at 1,071 crores with cash and cash equivalent of 1,806 crores. We will continue to utilize certain levels of our working capital required for the day-to-day working capital requirement in the normal course of business. The issuance of 1700 crore NCD by Raymond Ltd to RCCL is a temporary arrangement which will be netted off at the completion of demerger. This demerger will result into two independent net debt-free listed entities of pure play B2C focused lifestyle and real estate business with significant liquidity surplus at the group level to spur future growth. Coming now to the interest cost. The interest cost in the quarter is 79 crores, which is higher by 20 crores on a year-on-year basis as compared to 59 crores in the same quarter last year. The interest cost has increased on account of the following. Our borrowing cost increased on account of RBI rate hikes, which was increased by almost 225 basis points compared to first quarter FY2023. There is an interest cost of 10 crore on the NCDs issued to RCCL, which will be netted off at the completion of the demerger, as the effective date of the demerger is 1st April 2023. Higher interest on lease liabilities on account of increase in the stores which are opened are being taken on the rental basis. Unamortized transaction costs for external long-term loans prepayment from the FMCG business sales proceeds. Now let me discuss about the current status of the operations and outlook. As we all know that most part of the country received incessant rain that impacted the agriculture output, resulting in some somber sentiments as far as consumer demand is concerned. The discretionary spends have been impacted the most primarily due to inflationary pressures and increased commodity prices. Adding to this, there has been extended duration of overall discounting, particularly in apparel segment. The calendar year also has Adhik Maas that has pushed the festival ceremonies and weddings towards the end of the year. With Pitru Paksh period now concluding in the middle of October, all festivals are delayed, especially weddings being pushed from November onwards. Given the situation, we expect the primary sales to our channel partners will also be delayed in order to make our products made available in the market for the consumers before the festive season commences. In line with our stated guidance, during fourth quarter last year's call, we are on track to expand our retail footprint. We will be adding almost 200 stores in the next 12 to 18 months and will follow the asset-light franchise model. Thus will be driven by large store network expansion for ethnics by Raymond to cater to fast-growing ethnic wear market. In the garmenting segment, export lever continues to be China plus one strategy, and the global retail industry is undergoing consolidation. We have a strong order book in place for the next couple of quarters. The capacity expansion is well under progress to cater to the increasing demand from our customers. In terms of our raw material prices, while the wool, cotton and polyviscose continue to remain stable, however, prices of linen flaxseed have also been on an increasing trend. In the engineering business, we are witnessing that the domestic retail demand in consumer sectors are healthy and we expect the same to continue. However, in the export market, the inflationary trend continues to be in the economy of European countries as well as US and currency devaluation of certain developing economies. We are closely working with our customers in assessing the demand and catering to their requirements from raw material cost perspective. The steel prices have recently softened after going through an inflationary trend for the last 2 years. However, we have the ability to pass on the same with a time lag. In the real estate market, we continue to see growth momentum in the residential market. As you all are aware that we created a benchmark in the history in the sector by delivering the first phase of the first project, 10x Habitat, delivering 24 months ahead of RERA timeline, and now with over 200 families residing there, the overall consumer confidence has been reinforced. The growing consumer queries and interest is a testimony to the fact that Raymond Realty is now a brand to reckon with and has been the largest and fastest selling real estate developer in Thane market. Recently in July, we launched a premium residential project with total RERA carpet area of about 1 million square feet with a revenue potential of over 2,000 square feet. We received overwhelming response with the 50 plus units being booked on the launch day itself. Regarding the net working capital, we have been consistently optimizing the net working capital in terms of number of days, and we continue to maintain the same. From a cash flow perspective, there is a continued focus to generate significant cash flow from the profitable growth of business. Thank you. Now, I would request the moderator to open the forum for the question and answer session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Himanshu Nair from Systematics. Please go ahead.
Yeah, hi. Good evening, team, and thanks for taking my question. Sir, to start with, if you can just give some more color on the demand environment, which clearly has been sluggish. So now do we sort of wait for things to improve externally, or are we taking any extra efforts, or are there any internal levers, maybe like marketing or price cuts or some more product innovation, or any of the other levers which we have internally to push growth higher till the time this overall environment does not improve?
Hello, hi. This is Sunil Kataria here. I'll take this question. So I think thanks for asking this question, a pretty relevant question. But two parts to this. First is definitely we have very optimistic that this environment is a short-term phenomena, and this will improve once the wedding season kicks in post first half of October. So I think that's the first piece, because we believe that in fact there is maybe a pent-up demand of the wedding season which will actually play out very bullishly in the second half. That's the first part of it. Now, I think having said that, the question is what is it in that is in our hands to stimulate growth further, and rather than only waiting for the season to come in. So I think we have got a couple of levers, and business. So, for example, in our suiting business, we have done a series of product innovations in both the mass end as well as in the premium end of the market. And both of them, the mass end innovation that we've done in the product, which is aimed at taking more and more share out of the multi-brand outlets, has already rolled in the market. And in the bookings, we have got a very good feedback. We expect that to gain more momentum. And the premium end offering that we are looking at launching, that will be rolled out in October and early November. So that's the kind of product innovation support that we are looking at. In shirtings, again, there has been a series of product innovations at the mass premium end, which again are giving us a lot of leeway, and we are seeing it's also, if you see, reflecting in the kind of growth that we already started getting in the shirting business. We also believe we have a headroom to grow in the shirting business in terms of sheer distribution reach itself, and that is going to be a very big lever in terms of expansion of our footprint of multi-brand outlets and shirting. In apparel, I think our results have been pretty strong. You are seeing a strong double-digit growth which is happening out. This is led by a focus on improving product designs and product quality, product portfolio. We have gone into casualization in a bigger way in Park Avenue and Raymond ready-to-wear, and at the same time, we are looking at expanding our footprints. International business continues to be strong for us, so I'll not talk about that. Apart from this, we have been investing behind brands, and our marketing spends have gone up. Come September onwards, just pre the season, you will see a lot of new marketing campaigns also hitting the market. So in a nutshell, with product innovation, go-to-market and marketing spends, we believe we are well placed to take advantage of the upcoming season or to stimulate demand. And plus, apart from this, we have already started expanding stores. You will see this acceleration of stores over the next 9 to 12 months in a very, very significant manner across our apparel portfolio.
So just a small follow-up there. Is pricing cut a possibility? Because we hear that in the new collection, some of the players are resorting to price cuts to boost demand.
So, okay, see, I think, this pricing cut or increase, I don't think so we are going to do it only from a demand point of view. What we have a policy is, when we make new collections, we actually do a very good product portfolio benchmarking exercise, where we see, okay, are we well covered in the mass end of the segment? Are we well covered in the mass premium and the premium end? And that is where we actually relook at the mix. And that is a mix we had a relook at in FY2023 season, which is just rolled out. And that is a relook at we have also had it at Spring-Summer 24, which will come there somewhere in terms of January end. Plus, if you see end of season sales this time started early, and that while it had a laggard start, I think it panned out, it picked up pretty much very well in the second half of the season. So that end of season sale also has panned out for us. And in fact, if you see, there is one brand of ours which is Parks, which is priced at the lower end of the market. There again, we have taken some, strong product portfolio introductions aimed at mass end of the market.
Got it. Thanks for the clarification, sir. Second bit is on the real estate piece. Now that is becoming a significant part of our portfolio. So, in terms of future visibility, can you provide some updates on any new projects which we might be looking at outside our own Thane land parcel, or do you think next couple of years the focus will be on developing this piece in multiple phases?
Yeah, so I'll just answer and I'll ask then Harmon to respond more. See, we have stated very clearly that our growth strategy is very clearly identified, that we are going to utilize the Thane land. And I'm sure if you have seen our presentation, we talk about the 100-acre has a revenue potential of close to 25,000 crore, of which 9,000 crore has been launched, of which 50% almost 4,200, 300 crores has been booked. And recently we launched further a project in Thane, which is the Address by GS Season 2. And, we have already signed a JDA in the Bandra, which we should be launching in the next few months. But we have said clearly that we will have the expansion route through a JDA mechanism. So that is where we will expand. And Harmon, if you're there, if you can add.
Yeah. So as far as growth strategy is concerned, I think we've been clear right from the beginning, and there has been no pivot away from there. Markets have supported us well. So Thane is a good launching pad for the business, and it will continue to be so. And outside of Thane, we are looking at expansion. First deal is already signed, as Amit mentioned, the Bandra deal. And we are expecting that to be put in the market shortly. Hopefully all goes well this fiscal itself. We will see the launch of that project, subject to all the approvals being in place. And as we go along, we continue to look at other joint development opportunities. And having said that, we are very cautious in our approach as to utilizing the capital very judiciously in terms of our growth. Because this is a cyclical industry and these are good times, so it is very easy to get carried away. So very cautiously we are looking at growth, but we see very good growth potential outside of Thane also. And the kind of response we've got from market participants and the deal flow that we have is very, very encouraging. But we are being very choosy in doing deals.
Got it. Very clear, sir. And final question, sir, would be on capital allocation. I believe now we are sitting at more than 1,400 crores of cash on a consol basis. So do we, and that is, as you say, is growth capital. So, do we wait for the demerger to finalize any further expansion plans, or do we have a plan in place right now to sort of, or at least a broad roadmap as to how we'll be utilizing the significant amount of cash plus the cash that we'll be generating going forward, which will be a significant number. So what is the broad allocation plan, if you can share something on that front?
Sure. See, look, we're sitting today with 1,500 crore plus cash. And as I mentioned, that during the demerger process, the total debt of the lifestyle will move to the Raymond Consumer Care, and the Raymond Consumer Care would have 2,200 crore of cash, and it will carry a debt from lifestyle to the tune of 1,850 to 1,900 crore. So 300-400 crore of cash will sit in the lifestyle business, and then you will have almost 1,100 crore sitting on the Raymond Limited, which almost includes 400 crore of real estate cash, because we are a completely net debt free on the real estate side as well. So to that extent, I think we have the plans. We have already initiated the plan on the lifestyle side. We are investing almost 200 crore of capex on the garment, expanding the garmenting lines by third of the capacity, and which should be completed over 12 to 18 months. We are investing behind the technology. We are spending almost going to be again in the next 24 to 30 months, almost 100 crores on the technology side, especially in the lifestyle business. So like that, we have chalked out the plan, And on the real estate side, I think the question is that we want to be careful that we don't want to just go. And as we have stated very clearly, we are not buying any of the land. We will do only a joint development project which will have enough and more opportunities available in the Mumbai market, MMR region. So that's the way we want to go, and just now the money has come for almost 2 months back. So therefore we have deployed into the liquid investment, and we will continue to explore the right opportunities and expansion plan in order to deploy the capital.
Got it, sir. Got it. So that's all from me for now. I'll jump back into the queue for any follow-up. Thanks, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Rohan Kale from Incred Capital. Please go ahead.
Yeah, hi, sir. Thank you for the opportunity. I have two questions. One is on ethnics. If possible, would you be able to share maybe like how the growth has been in terms of operations? Are we seeing any reasons that we may need to rework on anything? How are we sort of positioned there? That is one. And on the second part, on the real estate division, I see another new launch on your website called Invictus by GS, which just says coming soon. So is it possible to maybe shed some light on that project as well?
Yeah, absolutely. So what I will do is, I think ethnics it will be difficult for us to say the numbers, because what is happening is ethnics is just a start of the business, and you need to see clearly the cycle for the wedding, which happens actually in the month of November, December, as it is delayed because of that extra month under the Hindu calendar. So effectively, any comparison right now, because we're starting from a very small base, would not be meaningful. So that is why I think for us, any commentary on the market and perspective is better to be done after November and December. So you want to add something?
Yeah, no, I think that's a point which Amit has already said. I think our clear focus right now is on making sure that we have the best-in-class product portfolio and designs, and which I think today we can give a feedback very clearly is that from the stores which have got launched out and the consumer feedback that we continuously get from the stores, I think we have hit bullseye at least on the right pricing and the right product quality and designs. So I think that is a piece which is very clearly established for us, because that's the heart of the whole strategy. The second piece definitely is that we have actually moved on to now 75 stores as we sit today, and the focus is to really expand and double this store network over the next 9 to 10 months, and that's the second focus which is happening. Come October, we are going to invest heavily. In fact, a month before that itself, we'll start investing heavily behind our marketing campaigns to make sure that we drive footfalls toward the stores. And I think that's when we'll really get a sense of the footfalls and the way the business pans out in these stores.
And the real estate.
Amit, I'll take the Invictus question. Yeah. So the marketing strategy, the way we are approaching the real estate business is that we are trying to build 3 brand properties, and one of them is 10X, which is a aspirational product, which was our first project with 3,100 units. And then the premium version was addressed by GS, which was Signature Homes by GS. And the third product offering we have is in the luxury segment, which is going by the name of Invictus. So the idea is to build these 3 brand properties and use them over and over again at different locations within Thana, outside of Thana, as per our stated strategy that within MMR we will be doing. So so the Invictus is the luxury and a very exclusive, very limited number of units, large apartments, and these are all going to be not finished apartments where the consumer will come and finish them. And we haven't really fully launched that, but the registration was done in July. We've got a fabulous response on this product also. So we have a very high level of interest on that. So that's Invictus.
Yeah, and just to follow up on... Just to supplement one thing, you see, we enjoy such a great market share for 5 consecutive quarters. We have been the number 1 market leader in the Thane micro market. Consistently, our products sold have been the highest. If I take 1, 2, 3, we enjoy almost, I think, 28 to 30% market share in the Thane micro market for 5 consecutive quarters.
Sure, sir. Just a follow-up on Invictus. So you mentioned about it being in the ultra-luxury segment. So will these be basically separate projects, or will they be like maybe, let's say, out of, a project with, let's say, four, five towers, one of them will sort of be an ultra-luxury? Just a clarification on that.
So all options are open in that sense, depending on the land that we are trying to develop. Each land will have its own characteristics and the planning constraints. So based on that, it can either be a separate gated community or it could be part of a larger complex where there could be some addressed by GS and some Invictus. Both possibilities exist.
Okay, sir. Thank you. I'll get back to you.
Thank you. The next question is from the line of Prerna Junjunwala from Elara Capital. Please go ahead. Prerna, the line for you has been unmuted. You may proceed with your question.
Hello. Am I audible?
Yes, you are audible.
Yes, you are audible.
So, would like to understand this branded apparel growth in this quarter a little more in detail. If you could share some channel-wise sales mix for the quarter and what really led to the growth apart from EOSS?
Yeah, I think very simple. You see the product range we have introduced. You know that we were a little bit a formal company and there was less and less casualization in the past. I think the whole focus has shifted to significantly boost the casualization part. And secondly, you have also seen some bit of a store expansion which is happening, and with a very focused which market needs what kind of a product that has helped us to achieve in this subdued environment, also to gain and increase the products and the growth.
So also just to add on to supplement this data, apart from, one thing we believe that the casualization piece that we have played out in parks by buffering our portfolio in Park Avenue, in Raymond Ltd, I think that started, doing well. We also are seeing that apart from our own retail channel expansion, which is helping us, we are also seeing what is coming where we think we are gaining market shares is multi-brand outlets, and also there is a LFS organic expansion of the footprint which is also helping us because we are now getting much more acceptability because we have a larger portfolio across multiple types of LFS, and I think clearly we are seeing some gains happening across multi-brand outlets. So I think it's a very, very, I would say, all-encompassing gain across channels, which is our own retail stores, MBO, LFS as well.
So just a follow-up on this, if you could put in some numbers to this in terms of growth or market sales mix or something to help us understand.
If you see, Prerna, what has happened is that we focus really on the parks, which has helped us to grow, especially the MBOs and the LFS channels. Then you have also seen a growth on the MBO, general MBO expansion, and the LFS where they are keeping our products.
And also, we are seeing actually it's a twin strategy maybe playing out for us that we are seeing both premium brands as well as the mass brands doing well for us. So we have seen pretty strong growth in Color Plus and Raymond Ready to Wear as well as Parks doing pretty well. So I think both sides are playing out. One end we are getting, thanks to the improvement in our product portfolios and focus, we're getting inroads into maybe multi-brand outlets. And in LFS, it's happening both at the premium end of LFS as well as the value LFS, which is now coming back into play. And at the same time, brands like Color Plus and Raymond Ready to Wear, which are more premium brands, are gaining because we are doing well through our own stores, and there is also footprint expansion also happening there.
Understood. Sir, how much of your exclusive retail stores would be COCO and franchisee driven?
Just a second. Yeah, so total our COCO stores overall in our footprint are roughly around 10 to 11% of our total business, and the rest are all franchisee stores. So we are very focused on making sure that, the strategy for us in COCO stores is that if there are some very, very marquee locations, which are high-end malls, or even some very high-end real high street comps, where we know that, okay, the real estate cost may be higher, but those properties are marquee properties that they actually drive a lot of brand equity per se apart from footfalls. Those properties we would like to invest ourselves. But otherwise we would like to follow more asset-light franchisee-driven model.
Okay, understood, sir. The next question is on garmenting piece. We saw 7% top line growth, but our EBITDA growth was 62%. Was any one-off, advantage that we had in EBITDA, or was it only input price driven, or was it sales mix? Could you please help us understand this EBITDA expansion in garmenting business, as well as sales mix in this garment, which is driving the growth?
I think what has happened is, you see, this is exactly the China plus one playing fully well. Now, previously the customers who were buying from China, they are starting to shift here, and some of the big players, very, very marquee players, have come to us, and who in turn give a comparatively better pricing for our products, and then you go to throughput more, and if you increase the throughput, you get operating leverage and operating efficiency. So it is, let's say, a bit coming from the sales price improvement, product mix improvement, and a bit coming from the operational efficiency and operational leverage.
Okay. So would it be fair to assume that volume growth would have been lower and price growth would have been higher because of mix improvement?
Yeah, you're right. It will be, volume growth is comparatively lower compared to the price improvement because of the mix. And see, at the end of the day, what is happening is that we also have an opportunity right now, as we continue to expand 1/3 of our capacity, that some of the volumes which are little low priced, we will keep it when we have the expansion of the facility, which we should see some benefits coming soon, as quick as in the next 6 months. So therefore, we are taking a better priced order right now and pushing some of the lower priced orders to when we have the expanded capacity.
Yeah. And one point I just like to add here is that thanks to us, see, we are also doing one thing in our strategy. We are now expanding geographies globally in a very, very big way. So let's say earlier we would have very strong clientele coming from markets like US. Now we are focused on new customer acquisition within US, but at the same time we have opened up markets in Europe, many clients. And those are new customers which are coming into play, are some very large global customers, and they are also opening, along with new geography markets, they are opening new categories for us. So one of the pieces we are seeing is maybe shirts is becoming also a new emerging growth category for us within the whole mix itself, thanks to new markets and new customers coming into play, which are driving almost fundamentally different mix itself for us. And as you know, shirts have a much higher retailer rates and much higher turnover within a wardrobe than what a suit would have, otherwise, or a jacket would have.
Okay, understood, sir. And the expansion that we're doing for 200 crores in this business, is it for only shirting, or is it a mix of woven as well as hosiery products?
No, this is across trousers, jackets, suits, and things. It's a complete across the wardrobe.
Yeah, and we don't do hosiery and we don't do woven.
Yeah.
Okay, understood. And last question on this segment only. Could you help us understand this new marquee customers? If you could name one or two, which would just help us understand.
We are bit hesitant or reluctant to tell you the names, but I can tell you some of the top European names which you can think in men's clothing, they are with us.
With global footprints, These are top European brands with global footprints.
Great, sir. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Ali Asghar Shakir from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. I had a question on the branded apparel business. So, we have, communicated our strategy to expand our network. While we do that, what kind of a margin trend we should build, given that you will be rolling out aggressive, network? Should we expect the margins in the near term to kind of see some impact because of the aggressive store addition, or because this is going to be on a FOFO model, it may not have any material bearing and we should see continuous improvement in brand apparel margin? So in that context, how should be their 3-year trajectory and where should it settle, the apparel margin?
Yeah, no, thanks, Ali. I think we understand that the way we are growing this business, we are looking 2 or 3 significant aspects of improving the margin. Number one, what you need is a store expansion. And we have stated very clearly that in the next 3 to 4 years, we would take our EBO expansion from a current level, almost double. We will open more than 450 to 500 stores over the next 4 years or so. That is a big expansion, and exposure creates demand. That is number one. Second thing, what is also happening is when you are selling and expanding of this level, you will automatically get a lot of operating leverage. So that is, secondly, it will help us to improve the margin significantly. Third thing, as we have also talked about, that we are very clearly investing behind these brands and making the products like the casualization on one end, premiumization on the other hand. Second thing, we will put money behind, as Sunil talked about, immediately after the Shraddh and such things, we will put out a large marketing campaign. So my view is that we should be good in the range of 13 to 15% in the next 3-4 years from now, which is in line with all branded players.
And one thing which really happens, as we do this now, we're seeing, finally, after you've created great products, what matters in this category also is brand salience and brand awareness. Now, you can actually go ahead and do large brand investments. If your footprints are stronger, your brand has got a scale in terms of reach. Once, as that has started happening, we are actually planning, we are investing behind these brands also, because we believe now we have got the mix by and large right, we've got the footprint right, and we are going to do brand investments. Now, it's a very difficult thing for me to do a brand investment and get return on it. If I've got 40 stores or 50 stores per brand, it becomes a very different game the moment I've got 150 stores per brand. And that is, I think, going to play out, which also, in a way, become, I believe, a kind of flywheel in itself. You do good products, you could do brand investments, you have the right go-to-market, and it's a kind of good churning model in itself, which then drives scale. And that's, I think, the model we are trying to build. We will, in this entire game, Ethnix will be a very critical, driver for us. On one end, we'll drive, as you said, Raymond ready-to-wear brands. We'll do Park Avenue and Color Plus, which is in the normal, apparel business. But Indian Ethnix Wear will be again a critical area of focus. We have 75 stores. We are targeting to double this over the next 9 to 12 months. And there are investment campaigns which will happen behind Ethnix as well.
Understood. Thank you. This was very detailed. Just quick follow-up. So 13-15% you were talking is post-Ind AS or pre-Ind AS, and at what revenue scale we should be able to achieve that?
Clearly, this is a post-Ind AS because now everybody talks that kind of a number, so
right.
It becomes very confusing to talk the other pre-Ind AS. So this is obviously post-Ind AS, and what we are talking about, today we are on a 1,400-1,500 crore kind of a run rate on the revenue side. I think we see, based on this store expansion and such things, in the next 3 years, easily hitting more than 2,000-2,200 crores of revenue. And then when you are hitting